Right, I think we're bang on time for 2 p.m. and a warm welcome to everybody. Thank you all so much for coming to join us. To those of you in person, it's wonderful to see you all in 3D. For those of you who are online, thank you for dialing in. Romy will be monitoring the online dial-ins for Q&A later, but for the moment, thank you very much for joining us. So we'd like to welcome you to our full year financial results presentation for the JSE. I'll kick us off with some highlights and before delving into the group performance, and after that, our Group CFO, Fawzia Suleiman, will provide a detailed overview of the financials, and then I'll close with an overview of our strategic initiatives. So starting, am I driving the slides? Starting with slide 4, you can see that the JSE delivered a strong set of results with an 11% increase in net profit after tax, translating into a 12.2% increase in headline earnings per share and a return on equity of 19.4%, which is very much in line with our long-term targets. This performance, as you all well know, is set against an extremely challenging operating environment, and it demonstrates the exchange's ability to remain resilient despite our largest contributor to revenue being equity trading, which was impacted by lower value traded. We're pleased to report a 6.9% increase year on year in growth in our operating income, and this number includes net margin income. An important feature to notice is that the quality of our revenue, with growth being supported by asset class diversification as well as trading income, now represents 37% of total income, almost R1 billion. The proportion of our non-trading income continues to increase year on year, very much consciously in line with our strategic intent, and this protects and cushions our profitability during softer market conditions. On the cost front, we continue to prioritize spending on strategic initiatives while maintaining a disciplined approach, delivering balanced or marginally positive operating leverage for the group. Opex reflects our commitment to investing in people and technology. Our cash generated from operations remains healthy at just above R1 billion, and it's up 13.6% year on year, supporting a strong balance sheet position. Therefore, for the year, we have declared an ordinary dividend of 784 cents per share, which translates into a dividend yield of around 8.5%, although that's shifted slightly with the increase in the share price since we announced yesterday. Finally, underpinning all of this is strategic partnerships and innovating in technology, both of which have been a very important priority for us. We launched new partnerships to enable us to rapidly innovate in data services, private markets, carbon trading, and importantly, a modernization of our broker-dealer accounting system, which will ensure that the JSE maintains its leading position among emerging market exchange operators. Moving on now to slide 5, it's important to set the scene for the environment that we're operating in. As you're aware, in 2023, global markets were heavily influenced by geopolitical tensions, tighter monetary policy, and supply chain pressures. At the local level, South Africa continues to face additional challenges with weak economic growth, high inflation, and escalating power disruptions. These, alongside the FATF grey listing, as well as the Reg 28 increase in offshore allowances, have negatively affected investor sentiment. While the macroeconomic certainty has translated into an overall shift in capital flows with less liquidity in South African markets, local investors have shifted their foreign assets, and international investors have equally reduced their exposure to South Africa. We can see this risk-off appetite in the top two charts, with emerging markets underperforming the benchmarks and lower volume and value traded in the equities markets. The biggest impact to the SA flows has really stemmed from two key factors. The first is that the SA's weighting has dropped to just over 3% in the FTSE index, just under 3% in the MSCI emerging index, and investors are now underweight the index. In fact, if we look at a long run average, the emerging market index weighting in the total global flows has reduced. In 2010, the emerging market index constituted 14% of total index weightings, and that dropped to about 12% in 2020, and that's now 10%. So only 10% of flows are going to emerging markets. And at the same time, South Africa has contracted in its relative weighting within that, partially outweighted by countries like India, Saudi Arabia, and a couple of others, and partly because of the contraction in valuation of South African stocks. Shifts in flows, as I mentioned already, to offshore allocations from local investors as a result of the Reg 28 changes in allowances, and global investors reducing their SA exposure have also affected our numbers. Of course, these are all in the base now, and so we don't expect the Reg 28 impact to be material in the year ahead. Most managers are close to their 45%. So as you can see in the bottom chart, this is clearly affecting the valuation of emerging markets, and in particular South African stocks, which now ironically present a fairly compelling investment proposition. The compounding effect of our local challenges means that it's very important for us to stay on top of these challenges and to ensure that we respond appropriately. Moving now to slide 6. I have mentioned the quality of our revenue earlier, which was really supported by diversification across the business units and the asset classes. And as you can see on this slide, we have various different buckets with different dynamics operating within each of them. And I'll unpack this further in the next couple of slides, and also in Fozia's financial section. Something important to note here is that we reclassified in the investor protection levy income from other income into capital markets. After careful consideration, we believe that it's more appropriate in this division, as the levy forms part of a product fee, which is part of the capital markets environment. This change was applied prospectively, and it resulted in about a 47 million rand operating income growth. And operating income growth, excluding this levy, would have been at 5.2%. Moving now on to slide 7, we've grouped together purely our trading and post-trading revenues. So all of the other business units have been excluded. As you can see, revenue from most of our asset classes in the green blocks has increased during the year. However, equity market trading and obviously then consequently the post-trading equity clearing and settlement are down due to lower value traded or subdued activity. The macroeconomic context has led to a risk-off appetite for investment in emerging markets, as I said earlier, and there was less liquidity in our markets with a shift in capital flows to foreign assets and to safe havens. Despite the published equity value trading being down by 9.5%, overall overall revenue from trading and post-trading was up for the year due to activity in other asset classes. Another component to highlight would be the increase of 30% in our co-location revenue, which Fozia is going to unpack a bit more in more detail. And all of these added ancillary services go to the diversification of revenue, but also to the reduction or to the management of our overhead costs. Despite the macroeconomic overhang and the geopolitical concerns, we saw pretty decent demand in the bond market purely on a yield play. And this was supported by decent local and foreign interest. Global volatility in the interest rates and higher for longer concerns around the inflation cycle provided an underpin for activity across the bond markets over the equities. Meanwhile, for currency derivatives, which you all know has been on a decline for a number of years, we witnessed an increase in trading activity off the back of rand volatility. In the interest rate derivative space, there was higher demand for bond futures, albeit off a lower base, for hedging purposes. And we also saw an uptick in interest from new offshore players. For the commodities derivatives, higher trading and hedging activity was linked to the collapse in the grain corridor deal between Ukraine and Russia, the drought in South America, and also strong demand for grains and oilseeds and volatility in the oil market. So we saw in this market overall much more activity in the second half of the year than we saw in the first half of the year due to largely uncertain weather conditions. While clearing and settlement is directly linked to trading in the post-trade space, we did see a slight increase in the revenue for BDA and funds under management, which overall led to a flat performance for the segment. JSE Clear, which started operating as an independent clearinghouse in January of 2023, also reported higher revenues off the back of a new clearing membership fee and also growth in the underlying derivatives markets, as you can see by those green derivative bars. Investor protection income was also higher, owing to an increase in the levy and the reclassification being applied prospectively. And then finally, margin income continues to be supported by a favorable interest rate environment. On slide 8 and on a similar theme, we want to move on to illustrate the progress of our diversification strategy. And this is at the heart of the results. Previously, you would have seen a very different outcome had our equity market been down by 9.5%. We continue to invest in defending our competitive position in our core trading activity while building new services across the asset classes and private capital raising, information services, JSE investor services, and all of these enabled our non-trading income to increase by 37%. You can see in the red line of operating income, very much in line with our long-term strategy. In 2023, the JSE successfully demonstrated financial resilience. The graph displays average daily value traded in the green and total operating income, which is the blue bar, and non-trading income as a percentage of operating income. Over the past periods, you will see that the lower trading activity typically resulted in a decline in operating income. So the relationship was slightly more correlated, especially in 2019. And if you take this back, you can see it through history. Where we see in 2019, the ADV was down 7%. And although we were able to limit declines in operating income, it wasn't in a positive territory. And then since 2019, the increase in our non-trading revenue has enabled us to reduce that impact of the trading environment volatility, and it supports greater financial resilience in the business. For the first time this year, we see a new trend where that relationship is uncoupling, and average daily value traded being down by actually 9.5% and total operating income up by 6.9 or 7% rounded. And this really demonstrates the cushioning factor of our non-trading income, and it largely consists of market data fees under the information services business, JIS, JSE investor services, and margin income and co-location fees, as well as primary market fees. So overall, you can see that we are starting to demonstrate an improvement in the quality of earnings, and this is also a very important indicator of the future, and it allows us from a market participant perspective to more broadly spread our overall overhead costs across a much bigger revenue base. So it's good for the market and it's good for JSE Limited. Then as I move on to slide 9, I want to just briefly reflect on the strategic progress. Much of these are non-financial measures. Many of them are driving revenue, though. As you know, we've got these 3 pillars: protect the core, transform, and sustain our marketplace. And our core business is critical and continues to generate strong returns for shareholders. It will remain an important priority. So starting with the first bucket, operational resilience is well above the long run average, 99.8%, above the 99.3% and much above the SLA. We launched securities collateral, which we're very pleased about because this will reduce costs to the market. Market participants are now able to post govie bonds rather than cash. Our STT upgrade, which was an enormous tech upgrade, was ahead of budget, and it was ahead of time and below budget. Our cloud-based co-location services we're very pleased about because this really takes us into a next generation of offering services in the cloud. You would have seen the Amazon announcement. This is with a group called Beeks, a very well-regarded global company, and this is reducing the average costs for our brokers. Brokers who are in our co-location center, bearing in mind that 69% of trading goes through the co-location center. It's a highly sophisticated center, but many of the brokers don't utilize their full racks that they have. So we have had some large players moving into this new service, and this drive is really to start. It's one of the many things that we're trying to do to reduce costs and to reduce margin pressures for our members. Our sustainability bonds grew by 17%, and our actively managed certificates grew by 91%, and we have a healthy pipeline for both of those. We've spent a lot of time on listings requirements, so I'm not going to talk to that in detail. On the transform, our JIS revenue growth of 20% is something that we're very pleased about. If you look at the NPAT CAGR since that business was onboarded, we'll just take it from January so that we've got an annualized view. It's over 60% that we've been able to deliver. And the importance of this means that A, it protects us from the ups and downs of revenue, and B, it's taking up 2 of our floors in the building, for example, and it absorbs a large part of our overall overhead costs, meaning that we have more ability to manage our pricing more effectively for the trading environment. Data Lake is embedded and all our essential equity and bond data is moved to the cloud. We're excited about the big XYT ecosystems. It's an exchange first. Again, another partnership with a large global provider, which puts us at a very high level of innovation and next generation technology. Our carbon market was launched in November, and we've had good take up of clients who are looking to sign up. This is a long run project, and we don't expect results in the short term. We did deliver a tokenized digital assets prototype with the SARB and banks, and we are continuing to investigate the digital markets. And the bond CCP project is progressing very well. Under the sustainable marketplace, we are very pleased to announce that we have moved from BEE level 1 to level 2 to level 1. You'll remember that in sort of 2019 we were BEE level 3, and this is a very important component for our members. And so we've jumped up in the number of points quite substantially, and we are well within the BEE level 1 status. Our net promoter score is at an all-time high, but we are working on that, and we think we need to do even more to try and improve what we deliver to our clients. So I'm going to now hand over to Fawzia, who will take us through the financial results.
Thank you, Leila, and good afternoon to everyone. I'd like to start with our key financial highlights, and then I'll unpack the detail as I go along. So let's start with the income statement metrics first. Our operating income, which is operating revenue plus margin income, is up by 6.9% year-on-year, and this was driven by the asset class diversification, supporting capital markets revenue, as well as contributions from non-trading income, as Leila went through earlier on. We saw double-digit growth in information services and in JSE Investor Services, and JSE Clear also reported double-digit growth. On our OPEX line, we saw an increase of 6.7%, and this mostly reflects investment in our people and technology, supporting our implementation of our strategic initiatives. We also saw the impact of inflationary increases and negative currency, and we saw that reflect across elements of our cost base. EBITDA margin was down 4 percentage points to 38%, and we saw strong growth in net finance income, which was up 66.4% due to the favorable interest rate environment. Meanwhile, NPAT grew by 11%, reflecting solid profitability, and this in turn led to an increase of 12.2% for headline earnings per share. If we move on to cash and capital allocation, you'll see that we continue to report healthy cash generated from operations, and around 1.1 billion rand cash was generated from operations, which represents an increase of 13.6% year-on-year. We did also increase our Capex by 22.4%. We spent 155 million Rand in 2023. And while we still remain focused on protecting the core business, we are pleased with the increasing investment in our growth initiatives. Very importantly, we continue to maintain adequate cash and regulatory capital at 2.5 billion and 1.1 billion Rand respectively. Finally, we declared an ordinary dividend of 784 cents per share, and that is up by 2% from last year, while our ROE margin was up to 19.4%. Moving on to slide 13, I just want to quickly break down our overall revenue performance. As Leila mentioned earlier, equity markets, and in particular emerging markets, continues to be under pressure. And we saw a direct impact on revenue linked to trading value and transactions, which were both down for the year. But despite the difficult trading environment, revenue in our largest segment was still up 3% for the year. And this was driven by the higher bonds and derivatives revenue, which was up by 16%, which offset the lower equity market trading revenue. Equity derivatives and primary markets revenue both reported a 2% increase year on year, while commodity derivatives was up by 11%. Moving down the table, I am pleased to note the progress that we have made in growing market share and our service offering at JSE. Revenues were up a strong 20% for the year. The post-trade segment was flat year on year, reflecting the subdued market activity. Clearing and settlements revenue was down by 6%, in line with the lower equity market value traded, while BDA and funds under management were up by 5% and 9% respectively. JSE Clear reported 16% growth, and as you know, this is a new reporting segment as we started operating as an independent clearinghouse in January 2023. Derivatives revenue for 2022 has been unbundled and restated, so it's been excluded from capital markets and included in JSE Clear for comparative purposes. Finally, the information services business also delivered solid growth of 16%, with contributions to operating revenue increasing from 15% last year to 17% in the current year. On the next few slides, I'll unpack the underlying drivers for our revenue segments. And we'll start with capital markets and JIS. Equity markets trading revenue was down as expected, given the dynamics that we discussed earlier. Revenues were down 5%, while value traded was down by 9.5%, really demonstrating the effectiveness of our diversification strategy. Colocation revenue was up 30% and now contributes 69% to value traded compared to 66% in the previous year. Primary markets revenue was up by 2% as additional capital raise increased from 13 billion to 41 billion rands. And while the IPO pipeline and interest has improved, the timing and execution thereof remains constrained due to the macro environment. We've seen decent growth in the structured product suite, in particular issuances across ETFs, AMCs, and warrants, and our sustainability bond segment also grew year on year. Bonds and financial derivatives revenue was up 16%, owing to a 20% increase in bond nominal value traded and an increase in contracts traded for currency and interest rate derivatives. Equity derivatives revenue was up 2%, while value traded was down by 4%, and circa 80% of activity remains concentrated in the main index futures contract, which was flat due to muted hedge activities. The uptick in option structures and the price increases in the international derivatives product supported the overall increase in revenue. Commodity derivatives revenue was up 11%, with the number of contracts up by 4%, as we saw more trading and hedging activity in the second half of the year off the back of uncertain weather conditions. And then lastly, JIS revenue was up by 20%. This was driven by 10 new client wins for the year, elevated corporate action activity, and an uplift in margin income on the back of higher interest rates. So overall, since January 2021, JIS has delivered a solid CAGR revenue growth of 23.5%. In the post-trade segment, we see that our clearing and settlements revenue was down 6%, and that was as a direct result of lower equity value traded, with billable equity value traded down by 5%. On the other hand, BDA revenue was up 5%, following an uptick in the number of equity transactions. Funds under management revenue was up 9% due to the higher JSE trustees' cash balances. And JSE Clear, our new reporting segment, was up by 16% due to the growth in our underlying derivatives markets, as well as the introduction of the clearing membership fee. As a result, the overall segment was flat year on year. Moving on to information services, we see that information services reported solid double-digit growth of 16%. Now, this segment continues to benefit from the US dollar denominated revenues, and growth was primarily driven by the higher index revenue related to US partnership contributions from FTSE Russell. Important to note that increasing US dollar denominated revenue is quite intentional and part of our diversification strategy. We also saw steady growth in our core market data products, coupled with the positive FX effect has resulted in the increase that we're reporting in this segment. Moving on to slide 17, here I will unpack our OPEX growth, which really largely reflects the spend on our people and technology, two key pillars of our business. Personnel-related costs increased by 13% to 784 million rands, and this increase is attributed to our annual salary adjustments, as well as a rise in incentives. Now, incentives were higher, owing to good levers and retention cost in 2023, and that was set up against a lower LTIS in the prior year as a result of lower LTIS vesting. Technology cost increased by 11% to 384 million rands, and this increase reflects spend related to our growth strategy. Elements that form part of our growth initiatives include information services strategy, as well as our cloud foundation, whilst BAU-related expenditure relates to software and hardware support and maintenance, licensing fees, as well as cyber resilience initiatives. We did also see the impact of inflationary increases and a negative currency impact, in particular on this line item. Depreciation and amortization expenses decreased by 24%, and this reduction is related to a change in the estimate of useful lives of capitalized software and systems. Our regulatory compliance and other costs increased by 7% to 277 million rand, and this is primarily due to the new cost associated with the independent clearinghouse, as well as an increase in the trading levies that we saw come through this year. Some of these costs are passed on to our customers, and the related revenue is now reflected in operating income. Lastly, our general operating expenses have increased by 14%, and this growth is largely attributed to the impact of the operating environment and, very importantly, in the investment in our strategic initiatives. We did also see the impact of unclaimed VAT expenses come through on this line, as well as data information charges that supports revenue in the business, and then there was increases in utility costs relating to diesel. We will continue to proactively manage and to strike a balance between managing cost growth and spending on strategic initiatives that strengthen our core business and enhance our capabilities for the future. Next, I'd like to move on to our Capex spend, and we see that it was in line with expectations. We spent 155 million rand in 2023 versus 127 million rands in the prior year. Now, around 80% of the spend was on maintain the business initiatives, which includes rejuvenation of infrastructure and systems. We completed 3 operating systems platform upgrades as well as a system migration. We also upgraded our STT platform, as Leila mentioned earlier, and we spent on items for regulatory enhancements. The remaining 33 million was spent on growth initiatives, and this related to our information services growth strategy, progressing the bond CCP, as well as new market development in digital assets. In 2024, we expect to spend within the range of 145 to 165 million rands, and the components that we will invest in will be quite similar to the previous year. Moving to the next slide for a quick view of our cash position, you will see that the JSE continues to retain a strong liquidity profile with a closing cash and bonds balance of 2.56 billion rand at the end of 2023. In addition, net cash generated from operations was 1.1 billion rands, and our investing activities included investments in intangible assets, the acquisition of plant and equipment, as well as investment in government bonds. Financing activities comprise the acquisition of treasury shares and the repayment of our lease liabilities. Moving on to the next slide, I thought I'll just spend a little bit of time to break down our cash between ring-fenced cash and available cash. Now, as you know, the group holds 2 levels of non-distributable cash. The first is the investor protection and other funds, and the second, very importantly, is regulatory capital. These collectively amount to around 1.46 billion, which leaves us with 1.09 billion of cash, which is available for various different aspects, and that includes Capex spend, working capital, other investments, as well as shareholder returns. And all currently planned investments can be funded from the group's cash resources. And then moving on to dividends. As you are aware, we have announced an ordinary dividend of 784 cents per share for 2023. This is up 2% year on year and equates to a distribution of 681 million rands and a payout ratio of 82%, which would have moved since yesterday. We reiterate our commitment to a dividend policy which equates to a payout ratio of between 67 to 100%, and the policy enables us to have a flexible approach to balancing cash between the shareholder returns and the investment in the business. My apologies, the payout ratio wouldn't have moved. It was the dividend yield that would have moved from yesterday. Okay, and then finally on slide 22, we have outlined our guidance for 2024 relating to OPEX, Capex, and to the dividends. From an OPEX perspective, we do expect our cost growth to be between 5 to 8%, and we will continue to proactively manage our cost. Drivers for our cost include spend on technology, our growth strategy, and increases linked to inflation and a weaker rand. We are guiding to a Capex within the range of 145 to 165 million, as I mentioned earlier, and we will continue to invest in our growth strategy as well as to maintain our operational resilience. Then, as mentioned before, we will pay a dividend in line with our policy of a 67 to 100% payout ratio. And then finally, we remain committed to growing our non-trading income with the view to delivering sustainable quality earnings. And with that, I'll hand back over to Leila, who will conclude the rest of the presentation.
Thanks, Fawzia. And moving on to slide 24, we concluding the earnings presentation. We wanted to provide you with an update on our strong value proposition and our key strategic focus areas. So we have been transformational and innovative over the past few years as our business model has adapted to a changing environment. We continue to partner with world-class network providers to ensure that we provide best-in-class services to our clients, and we've maintained strong-term relationships with our global exchanges to cater to a wide diversity of clients. In 2023, we collaborated with Beeks Group and we expanded our cloud-based co-location service offering, and our best-in-class infrastructure as a service, which is called Colo 2.0, has not only resulted in an enhanced market access and improved trading speeds, but it's also provided cost savings to our clients, as I mentioned earlier. And that ranges between 25 and 30% for their infrastructure and their maintenance costs from alternative cloud providers. We've also expanded our product range to include analytics and data solutions. We launched Big XYT Ecosystems, and that is a business that will offer analytics as a service. And that's a capability designed for global exchanges and their ecosystems. And then finally, transformation and innovation are essential to everything that we do. As part of this strategy this year, we're engaging in a BDA transformation project, and I'll comment on this a little bit more in the next slide. The JSE has strong foundations which are going to enable the exchange to remain resilient and adaptable to unfavorable and unexpected macroeconomic challenges. However, and moreover, we are well positioned to execute on our strategic priorities. We've got a long-term track record of maintaining settlement assurance. Our technological infrastructure is robust and we've delivered 99.89% of availability, and we offer deep and liquid markets alongside enhanced market access with improvements to latency and connectivity. Our very sophisticated co-location data center is aligned with global standards, and it offers the fastest trading and market data access to all of our JSE markets. So basically a 10 microsecond round trip latency, which is super fast, I'm told. Our indices are globally aligned and we have credible benchmarks for the SA performance. And then finally, we are an established and credible financial market infrastructure. We have a long track record of robust regulation. We have deep and strong regulatory capital, deep equity reserves. We mentioned, you would have seen in the results, 4.4 billion rand, and a multi-class asset exchange, which gives us revenue diversification and it supports us through the cyclicality of these businesses. And these features really underpin our competitive value proposition. Next on slide 25, I wanted to just briefly provide you with an overview of our strategic priorities for 2024. As you know, we've got these three buckets as part of our pathway to achieving our financial targets. In order to protect the core, operational resilience, stability, expanding our cloud initiative are crucial. We migrated all of our data sets, or we will be completing the migration of all of our data sets to the cloud-based data lake, together with 1 year of a minimum of 1 year of historical data. And this project is critical to enabling our strategy. A cloud-based solution allows us to easily access quality data and better understand the needs and trends of our clients. And in 2024, we'll continue migrating these data sets and add additional history. Our focus will be on completing essential functionality across all 4 of the foundational components, which make up about 50% of our allocated investment in this area. We'll launch new data products and expand our offering to and our revenue mix while establishing the big XYTX ecosystems, and we'll continue to deliver on the Trade Explorer Analytics solution to global exchanges and to their ecosystems. And then additionally, focusing on transformation of BDA, which I'll talk about in a moment. As part of the second bucket, which is transformation, we'll continue to grow our core products and services, increasing annuity and non-trading revenue further, but also progressing on the bond CCP, which is a multi-year product or project, and our progress on our IS strategy and M&A opportunities and partnerships for revenue in the data space will continue. And then on the sustainable marketplace, we're going to continue to focus on client satisfaction, talent retention, and progressing listings reform. Next, I wanted to spend a little bit of time talking to you about some detail on the BDA transformational project, which I mentioned earlier. So just to provide you with some context, as many of you in the room will know, the system of BDA is a more than 25-year-old system which is running on a legacy mainframe technology. Right now, the skill set is very niche. We're dependent on key people, and we're also dependent on a single provider. So we've therefore decided to modernize the system, and this will also enable the transfer of data to the cloud and enable cost efficiencies, which will position us to innovate and increase our agility. We plan to convert the software from COBOL to Java, and we've partnered with Amazon Web Services to assist in this project. They have an excellent track record in this space, and they have the experience to de-risk what is a complex project. Our first steps will involve the assessment of the application functionality, the development of a proof of concept, and building a minimum viable product. Ultimately, the transformed BDA system will result in a modernized interface. It'll improve user experience. It's going to lower costs with the running system, and it'll pass these savings on to our brokers. It'll also provide us with the ability to innovate a lot faster. Now, I know that one or two people in the audience or dialing in have been asking about what has our investment in the past looked like. It looks like the revenue stream is high. The BDA system is a very expensive system to run. It costs us more than double what our MIT trading system costs. And the MIT system supports multiple asset classes. So you will remember, for those of you who have been around for a while, that the systems replacement project, which was an initiative to modernize the BDA system, was not successful. And in 2010, we had impaired 500 million Rand as a result of that. So that was money invested, but not successful. In 2016, I actually personally ran the T+3 project. The first phase of that project, it was 3 phases, was focused exclusively on upgrading functionality in the BDA system, enabling a number of reporting requirements which the market wanted, as well as regulators. The BDA costs for that project were a very material component of our T+3 project. Between 2016 and 2024, there were a number of functional enhancements. A large part of those focused on corporate action changes. In 2017, we upgraded the BCX mainframe, and there were BCX and EOH costs involved in that. And then in 2018, we upgraded the system to enable collateral management with Straight. And then, of course, we had ICB sector classifications. And then in 2021, we undertook a very major project to move the mainframe from BCX to the JSE data center, and that was to de-risk that system, and that was a high-costing project. Over the last year or two, there's been quite a bit of time and money spent on evaluating the potential move to a new model, removing the mandate of BDA. And of course, this year, you would be aware that we've announced the modernization program, which has already started. So you can see over the years, quite a bit of investment has gone into the system. And really now where we're at is a complete transformation and an upgrade to a system that is based on very old technology. And then in closing, I really just want to reiterate what we've been talking about through this presentation. And this is really just concluding by committing to our commitment to value creation. The solid foundations of our business model are underpinned by healthy cash generation, a very robust balance sheet, and a sustainably high ROE of between 17 and 19% between over the last sort of 5 years, and well above the cost of capital of 14.5%. We have resilient financial performance despite declining revenue from some of our core businesses due to market dynamics. And our performance is protected through the strategy of revenue and the strategy of revenue and asset class diversification. For the year, we will remain focused on increasing revenue diversification by continuing to diversify our segments and continuing to focus on the core too. We'll also continue to maintain our core value proposition through resilience and stability in our markets, making sure that we remain within our long-run average availability and our SLAs. And our client value propositions include deep and liquid quality markets, which are enhanced by market access improvement in latency, connectivity, and broadening of our products, including the analytics and data solutions. We'll continue to explore strategic partnerships and implement innovative technology. And we are still considering value accretive M&A opportunities. We've seen strong returns on our funds that have been invested in M&A. As I mentioned earlier, the NPAT CAGR the revenue increase in the NPAT CAGR since January of 2021 of JIS has been 23.5% and 62.1% respectively. And you will see in our balance sheet that we have a healthy return on the global cap investment. And then finally, we have a stable dividend profile, which has grown by 3.3% CAGR on dividends paid for the period of 2018 to 2023. And we remain confident in executing on our priorities despite a very challenging environment. We committed to delivering value to our stakeholders through operational resilience, innovation, positive and increasing contributions of our non-trading revenue while maintaining our capital allocation optionality. So with that, I'd like to thank you all for your time.